Welcome. Now, what happens in the buy, borrow, die strategy when the Fed hike rates? This is a massive concern because what it really does is it exposes the weak investors from the strong investors. This is the one time where your portfolio structure truly matters the most. And I love the fact that I've set this channel up during a high interest rate environment because everyone looks like a genius when interest rates are 0% because it's so easy. Assets are all going up, debt is cheap, and everyone's talking about, buy, borrow, die. You see all the videos online. But as soon as the Fed hike rates, it's like, the strategy doesn't work anymore. And it's absolutely not the case. It just means that the person didn't have the right portfolio. Now, during the actual progress of when the Fed is actually hiking rates, this is when the environment is at its worst. Because really, during the actual hike, there is not really any safe investment, only cash. If you invest in, a treasury bond, it could lose value it will lose value as soon as the Fed begin hiking rates and the yields start to go up and the value of your bond is now less. So bonds aren't safe. Stocks are in the process of crashing because the rate of bonds are going higher. The risk-free rate is getting higher. So all these institutional investors, massive pension funds, are just parking the liquidity. And they're going to just invest in treasury bills or high yield savings, or just parking it in money market funds. Because why take a risk? Why would take a risk on a volatile stock when you can do nothing, stay in bed and get, 5-6%? So the cost of your debt is now going higher. The margin loan's getting higher. The Lombard loan is getting higher. And at the same time, your stocks are crashing. It's a very difficult time to believe in the strategy. And I thought this is the best time to set the video up because we're not really in a hiking cycle. But it lets you understand the importance of the structure, which I always talk about. And you're going to be even more rewarded when the Fed do eventually cut rates again. No one knows when that will be. I don't even know if the Fed themselves know for a definite. But we can guess and say over the next, 2 years or so. As a guess. So let's look at it. Because everyone's a genius when rates are low. Everyone's investing. This is where the real estate gurus come out in full force. They come out in full force and they're talking about cheap debt, buy property, and it always goes up. But in reality, when you take cheap debt out of the picture completely and look at property for what it truly is, it's an entropic asset. The laws of entropy destroy it. Yeah? So all buildings are subject to the second law of thermodynamics. The moment a house is finished, nature begins to destroy it. The roof decays, the pipes corrode, the boiler decays. I talk about this all the time. Yeah, so you have to install maintenance, capex, insurance, property taxes. Structurally, it is a depreciating asset. The earth tries to destroy it and tries to suck it back into the earth. Whereas stocks are a productive capital compounder. They are not reflective of, a physical infrastructure of a building. Yeah, software doesn't need to be maintained the same as a building. This is why your stock portfolio is your greatest wealth building tool. So what happens during the crash? Now, the Fed hike rate is not an extinction level threat. It is annoying. It will be more of a nuisance than actually something that's going to destroy the strategy. I ran two scenarios. One scenario during 2022 where we have two investors using the same strategy, but one panic sells to pay off the debt. because they're having a compression of two terrible things happening at the same time. The debt is getting more expensive and the stocks are crashing. Two horrible things which the investor says the strategy doesn't work anymore. Yeah, this is a strategy only for, low interest rates. However, investor B does not sell. They do not pay capital gains tax. But more importantly, their assets stay the same and continue to compound. Even though the assets are going down, the businesses are still making money. They're still generating cash flow. And it is a short-term pain. The businesses have not changed. Because the businesses that they're invested in are recession-proof businesses. They are big companies, the biggest companies in the world. And they're not victims to high interest rates. The only companies that are truly destroyed by high interest rates are companies that don't truly generate a real economic profit. Companies that are zombie companies, they only survive because debt is cheap. Unfortunately, that is like 80% of businesses in the world. Yeah. The businesses that truly push civilization forward can survive high interest rates. Yeah. High interest rates just show the truth of what you're really investing in. But most of the companies we're investing in, and I hope you're investing in, are the monopolies, are the biggest companies with true free cash flow. They do not worry about the Fed hiking rates. So it's more of a nuisance event than actually destroying the strategy. Because you have to think about it. The Fed had the rates for like 14 months. They were hiked. Let me check. Yeah, 14 months, I think. What was that? It finally hiked. It peaked at what? July 2023 to July 2024. Yeah, something about 14 months, yeah? So yes, this is painful. This is a painful time. And you're going to want to sell your assets. Yeah, but it's peak buying time as well. So it's a good time to deposit cash. If you want to sit your new cash in treasury bills or whatever you want to do, that's fine. But selling them is still a bad decision. That's what I'm trying to say. Pay the cash in. Use cash to pay down the debt if you really want, if you're really paranoid during these times. But the strategy doesn't change as far as selling it, because what happens to those assets over the next 10 years? That's what you need to continue to ask yourself. What will the asset be worth in 5 years' time? We know the Fed cannot keep rates high forever. There's a sovereign debt crisis. There's $40 trillion of debt. The only way to deal with that is inflation, which means we need to have low interest rates. So everything in the American system, the US federal government, want low interest rates. So if they ever hike rates again, it will not be for a indefinitely long time. We're past the days of the Volcker days where the country could operate on high interest rates. Yeah, we're not in that situation anymore. So the strategy feels painful for a duration. But this is why the portfolio structure matters. What your portfolio structure, you must understand what your weighted beta is in the portfolio. To do the strategy right, you need to outperform the cost of the debt and outperform inflation. That is your true, because we set such a strong hurdle rate. Yeah, so inflation, we call that 7%. That's what we use. 7% plus the cost of the loan, which means our assets must be compounding. I like to aim for 15%, depending on how cheap the interest rates are at the time. This is high growth ETFs, high growth companies combined with monopolies that generate free cash flow. These can be defensive companies as well as growth companies. If you do not know what your weighted beta is, you're really flying blind. Your portfolio is flying blind. You don't even really know if you should be borrowing or not. That's why I normally just say a hard baseline of like 20% is the borrowing. And I give general, the portfolio 70% growth, 30% defensive. These are all guidelines because, to be honest, every person is different. Everyone's financial situation is different. And it really would be tailored to you as an individual. Because the reason your weighted beta cannot be just 1. If your weighted beta is 1, that means your portfolio is just as volatile as the stock market. It just matches the index. You don't have enough growth to outpace your debt and inflation. You have to outperform both of them. So we need a little bit of volatility. But if we have too much volatility, it could cause potential margin calls if you are not careful with how much you're borrowing. See, the buy, borrow, die strategy there's a lot more to it than the internet provides. They just say, well, as long as you get 10% a year and you borrow your debt at 5%, everything's fine. That's not correct whatsoever. That's not correct. It's more detailed. There's a lot more to it. And this is what I just want to get across on the channel. Your portfolio is your proof of competence. And this is what I'm helping people with. I can look at your portfolio. I can see the weighted beta. I can see how much you can borrow. You might even be able to borrow more than 20%, depending on the assets in the portfolio. The point is, everything in the financial monetary system points towards not selling the asset. Yeah, obviously a single stock, it depends, but at least a growth ETF or an ETF. Even if someone came to me and said, look, I've already got the S&P 500, but you've said it's not got enough growth, I still would not tell you to sell it. If someone came to me and says, look, I've been using the S&P 500 because that's what I was told to do, it's still pristine collateral for a lender. So yeah, I would still not tell you to sell it. I would just move the portfolio towards more growth until we move your weighted beta to 1.3, 1.15. There depends on your situation. But we do not fear the Fed. We do not fight the Fed. And when your portfolio is structured in the right way, guess what's going to happen? See, when the rates do cut in the next 2 years, we're already going to be way ahead. Way ahead. Our structure is already set. And our assets are just going to explode upwards. Our cost of debt will reduce violently. And you're going to see the benefits of the strategy. And we're proactive. We're already set years in advance, ready for that time. And then that's when everyone else will start wanting to do the strategy. That's why I love the fact that the channel has been set up in a high interest rate environment. So good luck, and continue to study the frameworks. And in the description of my video, when I'm ready to begin the consultations, you can apply. If you're a high net worth individual ready to borrow for lifestyle, you can apply for your own personalized consultation from myself. I will look at your portfolio. Yeah, I will look at it and say, what is the weighted beta? What is the numbers? What is the growth? What is the defense? What is the risk? What is the exact contingency plan if there is a Fed hike? If there is a massive market crash, do you know exactly what the contingency is? You know, it's a full risk audit and letting you know exactly where you stand, so you're not flying blind. Yeah, so you can apply for that when I am ready to launch it. I will have that in the description. Keep an eye out for that, and I hope you enjoyed the video.